G'day guys, it's Jake here. Nothing in this video is financial advice. Please do your own research when it comes to investing. Please be sure to check out my links below, including exchanges I use and social media content that I post. Alright, let's go. Alright, so the topic for this video, we're going over the stock market. And at the start of the year, we'll have a look at the forecasts for different banks and where they see the stock market topping, specifically the S&P 500 index, and look at some other things, going over some charts of different industries and some tweets by some well-known figures. And yeah, we'll wrap up the video. Well, not in that order, but yeah, we'll wrap up the video there about the stock market. So we'll start with the Fear and Greed Index and where we are for the start of this year. And as you can see quite clearly, the Fear and Greed Index is reading 26, quite fearful. Again, it was extreme fear, which is quite interesting. I thought where we are now will be somewhere neutral or greed, but it says here we are fearful. All right, so click on the timeline and we'll have a look closely. This is going back typically 1 year ago. Okay, so January 2024, and you started that year very greedy. All right, and we stayed up greedy for quite a while, and we dropped off in April. Sort of made these lower highs. I had a high here, went down, made a lower high, went down. In August, we had that panic of the Japanese yen carry trade thing, and then we started trending up from there into October, and then we went down again into the elections, and then we shot up a little bit and started greedy, and now we're sort of selling off again, and we're at a measly 26, basically back to similar levels as it was in April and going to August. Okay, so that's where we are tracking for the S&P index in terms of fear and greed goes. So we are pretty well in a according to this chart, a fearful environment, but I don't really see that. But I think it's more or less a sell-off end of the year going into the new year. Pretty usual. I think it's a dead period for stock markets, whether it's for tax reasons, big companies, or it just quietens right down. And yeah, money needed for the holiday period. And those people are involved in the markets, so that's why I was seeing a sell-off there in the Fear and Greed Index. And you got market momentum, and this is versus 125-day moving average, S&P 500 in blue, and the orange or red, whatever color you want to pick it as, is the 125-day moving average. And you can see we're definitely well above it. So we are bullish but fearful at the same time, which is quite odd. But it's still in a big uptrend, okay? And you go back to January 2024. So it's been tracking pretty well up into the right. No nervous signs just yet. We are fearful on this dip that we've had, but nevertheless, we're still fairly above it. So the 125-day moving average is at 5,732.9, and we're currently at 5,868. So we're still above it by a little bit. And it's not really something to be concerned about. I think got stock price strength. We're extremely fearful. Going back again a year ago, okay, so we are more fearful at the start of this year than we were at the start of 2024. And you got breadth, okay, which is thousands of stocks, and it's to do with the amounts that are strong versus weak, and we're seeing the breadth is getting weak now, okay. So that is not a great sign. You want strong breadth. That's McLennan's volume summation index. And yeah, that's pretty well it for the fear and greed and the other metrics that we just talked about. That's the first one. The second one we'll talk about is, I'm going to go over this article by Josh Schaefer, okay, from Yahoo Finance. And he talks about, here's where Wall Street sees stocks heading after the best 2-year stretch since 1997 and 1998. So I don't know if you were around, anyone that was around that period watching this video right now. I definitely wasn't even born then. So I was born in 2000, but this was during the run up to the .com bubble, okay? One of the worst crashes we've ever had in the stock market, especially for the NASDAQ. It absolutely got destroyed, as it makes up mostly tech stocks anyway. And yes, it's a tech stock bubble that we got, and that was a pretty euphoric mania phase. And we are seeing, the 2-year stretch is quite similar to this period. So we'll go over this article and read through it. After 2 consecutive years of more than 20% gains for the S&P 500, an achievement not seen since the late 1990s, Wall Street strategists foresee a slower pace of gains for the benchmark index of 2025. With strong earnings expected from a widespread array of companies in 2025, the US economic growth anticipated to remain resilient. The fundamental story for the further market increases remain intact for 2025. But strategists have warned about a more volatile year for stocks as uncertainty surrounding Federal Reserve rate cuts and a new Donald Trump administration loom ahead. So always point to Donald Trump and what he's going to be doing in his first year of his 4-year term. And the Federal Reserve, of course, which is very, very crucial. They deal with rates. See what the rate cutting forecasts are in another video. We'll just go over what the Fed's going to do, especially for next week, as we've got job data coming out, which is very, very crucial, the job market, and obviously the Fed's very responsive to that data. Okay, we'll keep going. Bull markets can, will, and should slow their pace from time to time, a period of digestion that in turn only accentuates the health of the underlying secular bull. Said by the BMO Capital Markets Chief Investment Strategist Brian Balsky wrote in his 2025 outlook. So we believe that 2025 will be likely defined by a more normalised return environment with more balanced performance across sectors, sizes and styles. Balsky initiated a 2025 year-end target of 6,700 for the S&P 500. Given his 6,100 call for the end of 2024, Balsky's forecast returns in 2025 at 9.8%. He predicts right in line with index average historical gain. Okay, so we had a big year last year, and he sees a modest 10% return for the 2025 run, of course. Immediate year-end target for the S&P 500 among strategists tracked by Yahoo Finance sits at 6,600. This represents a 12% increase from the index's current level. All right, so this target reaches a high of Oppenheimer's 7,100. Wow. So they're the most bullish, this firm here. And low is Swyftx's mid 5,000 prediction. Okay. The loan call amongst 7 strategists tracked by Yahoo Finance for the benchmark index to fall in the coming year. This is the forecasts, okay, for different banks and funds. Okay, so we have the most bullish is Oppenheimer at 7,100. Wow, quite big. For the S&P, and we go down the list, Wells Fargo, Yardeni, Deutsche Bank, 7,000. So they're in that 7,000 category. And we've got a fair few in the 6,000. So not much different to what we are at the moment. So we're at 6,800 at the moment. So in the 6,000 category, you can sort of read that for yourself. And obviously notable ones are Bank of America and Morgan Stanley, Goldman Sachs, Barclays, JP Morgan, Citi, and UBS. And the most bearish of them all in the 5,500 price target is Swyftx. Never heard of them, but yeah, it doesn't seem, too well off. They're all, except for this one, I suppose Swyftx is quite well off, but it's all pretty well in the same at 6,500 to 68. So they're all very similar, and we just get a over 7,000 prediction for the top most bullish firm there. Less magnificent performance. In one sign of equities resiliency, Goldman Sachs chief US equity strategist David Costin and many others say that the market could surge higher even without the Magnificent Seven. Continuing. And, Apple, Google, Microsoft, Amazon, Meta, Tesla, Nvidia grew earnings year over year by 33% in 2024 compared to just 4.2% growth for the other 493 S&P 500 companies. So the top 7 had a huge year last year, 33% in a year's period is absolutely crazy growth for a big company of these sizes, over the $1 trillion marks. And then you get the rest of them, 4.2%. So basically, not good at all. Just over the inflation rate, really. It's not very good. But the margin is projected to fall to 8% points in 2025. Per consensus estimates, the Cosm believes it will lead the cohort, beating the other 493 stocks by 7 percentage points in 2025. Okay, so the Magnificent Seven will continue to outpace them. The narrowing differential in earnings growth rates will correspond with the narrowing in relative equity returns, Cosm wrote, although the micro earnings growth supports Magnificent Seven. So that's the projected growth of earnings. So S&P 500. So you got 7 versus the other 493. And as last year was C3, I just mentioned, and 4.2 for the other companies. The Mag 7 projected to do 21% this year, and then 13% for the other companies. And resilient US economy. Okay, so Lori Calvasina cited growth stocks as a crowded trade, leading to potential for more flows to value side of the market. Importantly, Calvasina's call relies on another commonly held belief among Wall Street bulls headed into 2025. US economic growth will continue to surprise the upside. For value to outperform in recent years, we've needed to see GDP run it a bit hotter, said Calvasina, who sees GDP in the range of 2.1% to 3% in 2025, above current Bloomberg consensus of 2.1%. We've given an edge supporting the market leadership, the shift in value, but I think it's a close call. So she predicts value to outperform growth stocks. Bank of America's Savita Subramania agreed. I can't even pronounce that one. It's a handful, that one, that name. Bank of America economics team projects the US economy to grow at an annualized rate of 2.4% in 2025. Okay. Higher than Bloomberg's 2.1% growth target. And then Bank of America favouring GDP-sensitive companies, financial sectors, consumer discretionary materials, real estate, and utility sectors. And a close look at Calvasina's work shows that economic growth meeting or exceeding positive expectations could crucial stock market rally dating back to 1947, and GDP has grown from 1.1% and 2% 5 times. Stocks were higher in just 40% of the time in those years, okay, with an average decline of 3.4%. Meanwhile, in the years, the GDP tracked between 2.1% and 3%. Stocks were higher 70% of the time, and an average return of 11%. Too many numbers there for me to look at. You can make up that. You can pause the video and read it yourself, but yeah, okay, we get the idea there. You need bigger growth. Okay, it's basically saying GDP is higher. We get to between 2% and 3%. We get 70% at the time that stocks were higher, and only 40% were higher during a 1 to 2% GDP growth. Okay, that's what it's saying. So the higher the GDP, the higher the stocks are most likely to grow. Okay, so you got UBS asset manager Evan Brown told Yahoo Finance Outlook. Brown said it doesn't take too much to change a widely held believes US economy equities outperform the rest of the world in 2025. So US being the leader again in business performance, and this is the S&P 500 during different GDP environments. Okay, from 1947 to 2023. So, you can see if the GDP is 0, we've actually had an 80% average return. Quite interesting, actually. Is that am I reading that right? It's, that's pretty interesting. That happens. Let me get 0.1 to 1% is actually that's higher GDP, but it's lower returns. And then you got minus 3.4% GDP. Average returns. Okay, so I'm reading this wrong. This is GDP. So 18% returns, and okay, I'm reading this right. So these are returns, 3.4%. It's up GDP between 1 and 2%, and then we have a increase in GDP from 2 to 3. We have a 10% return, 3 to 4, 8%. 4 to 5 is 11%, and greater than 5 is 8%. So it's quite interesting. Zero GDP can give you a better return than a positive GDP. Okay, that's what it says there. I don't know. And I think we'll end it pretty well. This Federal Reserve point here. Indeed, despite bullish prospects of the market, there are key risks to strategic calls that could lead to more volatility in 2025. One, a potential resurgence in inflation. The Federal Reserve earlier this month projected that core inflation will hit 2.5% next year, higher than previous projection of 2.2%, before cooling to 2.2% in 2026 and 2% in 2027. Stifle, the most bearish company of them all. Chief Investment Strategist Barry Bannister sees sticky inflation prompting the Federal Reserve to hold interest rates high as economic growth weakens. These factors may serve as a key catalyst to the eventual pullback in the stock market rally, which could result in S&P 500 ending 2025 in the mid-5,000s. So sticky inflation. We are seeing a bit of a resurgence in inflation, especially here in Australia. Very notable in fuel prices. They're definitely going up again. So we are seeing a bit of a takeoff of inflation, which is not good. I don't know what it's like in the US, because I don't live there, but here in Australia, we're definitely seeing it. Fuel prices going up. Groceries are pretty well high. Haven't really dropped at all. They've stayed steady. And our cost of living still out through the roof. Outrageous. Rents aren't coming down anytime soon. So, inflation is going to stay probably sticky. Our Federal Reserve, the Reserve Bank of Australia, hasn't even cut rates yet, because America has cut rates. So we're seeing a bit more inflation than the US is. They're a bit lower than us, but still in the Western economies, and we'll see what happens with inflation next year. This year, going into next year, especially this year. This could be the bullish year, regardless of inflation where it is. But it could be as bearish as Stifle predicts it to be, with their inflation forecast being sticky, or Oppenheimer setting 100. Okay, so there's a big range there, and anything can happen. Yeah. Next, we'll go to tweet with capacity ladder. Shocking stat of the day. The top 10 stocks in the S&P 500 are now almost 800 times larger than the 75% stock. Not even the Great Depression of the 1930s saw market concentration this high. It's now 50% more concentrated than 2001. So here's a little chart. I'll click into it for you. Market cap of the largest stock relative to 75% tall in the weight of the top 10 stocks in the S&P. Okay, so the weighting of top 10 stocks is quite high. Okay, it's not very good. Very high percentage, and it's higher than the Great Depression. Okay, the concentration is, you don't know when it's going to top. Like, this can keep going or trade sideways for a bit and then fall off a cliff, like it did here in the early or late 30s, I should say. We had a recession there, mid-1960 period. And then we had Nifty 50 collapse, which was terrible. .com, but this is a lot higher than these periods. This is Great Depression level of concentration, so it's very concerning. Okay, this market that we're in at the moment, and how they're chasing the top 10 stocks over the rest of the markets. And when there's so much concentration into those stocks, it's the anticipation for earnings and heavy reliance on just those handful of stocks to carry the rest of the index. So it's not a good thing to see. So that's that chart there. Next one, we'll go to another Twitter post by Macro Alf. 2-year Chinese government bond yields seem headed below 1%. This will be lowest level ever, even lower than the peak of the great financial crisis. So in China, their government bond yields are plummeting at the lowest level ever. Okay, he said ever, and I'm showing you right now it's ever. And going goes back from 2005 to now, so it's a 20-year period. Okay, and you see these bottoms, they're formed in this red line. This is basically halfway down that crisis happens, because you have 2005, 6, 7, 8 going into that last year, which is bearish. So this is sort of the top, the stock market thereabouts. Okay, This marked here, the US stock markets, and the yields took off up a rocket. And we had another period that was the closest red line, which was 2020, the pandemic, of course, in 2020 earlier there. And now we're seeing it again. So quite concerning. And stimulus they did over there hasn't done much at all to stop this going down. Okay, so the yields are pretty terrible. Okay, so 1% is well below, especially inflation in Western countries. And China's inflation is very low anyway, but this is not a good return for holding bonds. All right, so very concerning signs. Now we go to some charts to finish off. Okay, so we've got the S&P 500 index on the weekly time frame, and I've drawn a trend line from the correction we got in 2023. Okay, this is the period here, and we've been trending pretty well straight up there, nice and straight in a nice diagonal, I should say. I'm not very good with patterns. Diagonal line up until the right, of course, and we're tracking pretty nicely in a bullish uptrend. Now, if this breaks, I've got a level drawn here. This previous high, which is correction, we got for the Japanese carry trade thing that went on. Okay, so the fear went out. That was a top there, so I did mark it out there, and we touched it again here. So 2 resistance touches, and I do see it coming back down there very shortly, actually, breaking down, faking a lot of people out, and then continuing higher. That would be a nice reversal point to see the uptrend continue to trick people, because I do see a bullish year this year, particularly right towards the end of this mega euphoric year I see it being. Personally, we do, we can come down even lower, of course, 5,100, but you've got to be realistic here. From the top to here is a 7% correction. If you do get this low here that we formed, it's a 15% correction. So it's quite low, and that's getting towards a bear market, 20% to bear market. So I don't see correcting that low. Somewhere in this realm, 56.50 will be a nice correction, yeah, and then continuation upward. And the MACD would have to cross bullish, so the pink go above the blue and continue up, right, to confirm the reversal on the weekly. As you can see, it's going down and this price is going up. So we are seeing some divergence. Okay, so you got this high here. And change the color to red. So it's going, obviously clearly higher. And then you got the MACD going down. This is called divergence. It's bearish. So you should see a correction down lower. You see lower peaks here. And eventually a cross, like I mentioned. Okay. And when this cross happens, it will be bullish. Yeah, like this. And then potentially here, and then continue higher. We'll see exactly how it plays out, but that's what I'm seeing, something like that. I don't see this as the end of the rally, and we're just going down and nuking, and a big crash happens. So I do think the crash is going to be pretty brutal and terrible as we're coming up towards the end of the real estate cycle. Every 18 years is a real estate cycle, boom, 14 years and a 4-year downturn. So I've made a video about that on my channel. I won't link it, but I will make one coming up, okay? So describe the real estate cycle and what the stock market does during those periods, okay? So that is the S&P 500. We have the NASDAQ, quite similar, but we had a fake out low here, and then we are not near this line yet. We do come down to it. It will be interesting to see if it holds, and we're getting this similar sort of diverging pattern from this high in 2023 into the correction, which is showed in the S&P. Okay, so this one's a little bit different. It's got 4 peaks, 1, 2, 3, 4. Go back to S&P, 1, 2, 3. And actually, I should be drawing this line back here, all right? Because it does start here. So I did stuff this one up. My apologies. What am I doing? Oop. So I'll go back to these crosshairs, and I'll drag this back here. And that looks more neater. Okay, so you see 1, 2, 3, 4 peaks. And drag this line back. And we see 1, 2, 3, 4. So 4 lower highs and 4 high highs. So not a good sign. And we look like we're going to come down, okay? So that's S&P and NASDAQ, same thing. The S&P, see no different. Levels, haven't drawn any levels in this one yet. But probably around here, 20,000 level will probably be a good sizable correction yet, around here. So from 7% from the top, this will be about 10%, so quite a larger pullback because it's a bit more volatile than the S&P. So S&P, I did show you it was 7% roughly. 7%, yes, and then 10%. So it falls in line with those two being quite close to each other and pulling back to 20K before a continuation upwards. That's where I see it going, okay? I don't know when the correction is going to be, either January this month or February, March. Sometime in Q1. I don't see it being bullish. Like most people are saying bullish, bullish, bullish on Twitter. Q1. I don't know. No. This is Russell 2000, so it's a small caps, and we are approached the high 2021. We did wick higher than this one, so we are approaching the top of this. Could be distribution, or it could be a weighted correction, and then I just see a correction being a bit deeper than this, as I showed you for the rest of the stock market. As we're seeing a similar divergence, really, we've got this divergence is a bit sort of shorter, okay. Yes, so you got this high here and this lower high here, and we got this only from March, okay, to here, and then we'll see a correction, and this looks go lower. It looks quite because this pink line's dropping quite quickly, and the blue line should catch up, and we should see a bit larger correction from the top. Look, I am seeing probably around 90% correction. It could be a thing, or 15%. To 2K. So this is 2K here. So this is probably the most likely outcome because they are small stocks. They are a bit more volatile, and like 80%, right? 90% is pretty reasonable. Okay, correction before shooting up higher, breaking this 2021 high definitively, and this one here, of course, and going up and to the right. That's pretty well it. Okay, that's the Russell. It's a NASDAQ 10%, and then S&P least volatile 7%. So that's the stock market. I don't have predictions of where it's going to go. I have no idea. I'm not going to try it. Okay. Maybe in a future video if I'm forced to by commenters. But for now, I don't like doing price predictions, even for Bitcoin. It's a bit more easier to predict because it's got a logarithmic channel you can sort of track. But with S&P, it's very, very hard to predict. It's very, very difficult. Okay. It's a bit more. It's a lot bigger market, and price actions. Yeah, it's very difficult in the S&P. So that is the S&P, the NASDAQ, and the Russell, where I see him going for correction-wise, but price prediction-wise, we'll have to wait and see. So that is that. All right, I hope you enjoyed this video. Just going over the Fear and Greed Index, seeing that we are fearful. 26, back to August period, which we had the Japanese carry trade, and April of 2024. So similar fearful levels. So we'll see if we get a bounce from here or further downside correction, which I do see further downside eventually to these levels I just mentioned. Not big downside, but a nice little bit more correction. And then we looked at the article from Yahoo, so all the different banks and funds, where they see S&P going in terms of price predictions, also inflation and earnings potential between the Mag 7 and the rest of the 493 companies in the S&P. We also talked about the Chinese bond market and the yields looking pretty terrible and looking very toppy for the rest of the world. It's been a good indicator that I've showed you going back to 2008 crisis, okay, and the 2020 COVID crash, and now we're coming up. Or coming down, I should say. The bond yields are around 1%, to similar levels to those generally levels where we did see some panic afterwards, not far after that. So we'll have to wait and see there. And looked at, the concentration of the S&P, the top 10%, okay, the top 10 stocks, I should say. As concentration goes, and it's higher than the Great Depression period, right before it, the 29-29 boom, which was the most crash in the history of the stock market. Okay, so we are more concentrated than then. Where we get a bigger crash after 2025, no time will tell, but we are coming towards the end of the real estate cycle, so anything's possible. and housing prices are just ridiculously unaffordable. Rents are extremely high. People are struggling out there. So, and we have high interest rates. Interest rates haven't been cut yet in Australia, but in America they have. And I can talk a bit more of this in another video about the real estate cycle. So yeah, that's that. And we have some charts to summarize where we see correction coming, and like roughly what I see to bounce off and reverse and then continue higher. So I do see a bullish year this year as well. Probably not as bullish as Oppenheimer, but we'll see. The S&P stock market. But yeah, that is the video. So I hope you enjoyed it. So if you did enjoy it, please smash the like, comment your thoughts below, hit that subscribe button. Be sure to check out the links below, and I'll catch you in the next one. Cheers.